I'd like to welcome you to this video class, which is going to be covering IAS 28. So IAS 28 covers two types of investments, which is an investment in an associate as well as an investment in a joint venture. So before you watch this class, you need to have gone through IFRS 10 to determine control and understand the issues relating to power, and should have also covered another section which is on IFRS 11, which is where joint ventures come from. So for the accounting of those joint ventures, that's when you then finally come to IAS 28. So to begin with the class, I just want to first highlight the levels of power which you did with Hope in the IFRS 10 video class. So Hope highlighted that there are the four major distinctions of levels of power when one entity invests in another entity. And you discussed about when there is a simple investment in equity, that in simple investment may probably not give you any form of power at all. So you don't have any form of influence or control that you have over any entity. So for that type of investment, you agree that you account for that one under IFRS 9. And then you shifted from that type of investment and you considered other investments which you can make. But those investments, you've got a certain degree of influence that you can have. So when you've got significant influence over your investment, then that's when you jump into IAS 28. So IAS 28, when you come to this, you're considering that you've got a certain degree of influence. So the accounting for that differs from that of IFRS 9, and to jump into what we deem to call equity accounting. So that's the one that we want to focus on in this video class, which is equity accounting. Then later on, you're going to do when you've got full control of an entity, or whether they've got joint control, which is when you apply IFRS 3 and IFRS 11. So for this video class, we just focus on IAS 28, which is equity accounting under an associate where you've got significant influence. So to begin, let's talk about what exactly do we mean when we talk about significant influence. So for significant influence, you're saying the decision-making process which is being done by your investee, you've got some sort of influence over that decision-making process. So it might be relating to financial policies which are being put down, operational policies which are being put down. As long as you've got some degree of influence over how that investee is being run, then we say you've got significant influence and you're supposed to apply equity accounting as per IAS 28. Now, how do you know that you've got significant influence? So there are a number of pointers which tell you that you've got significant influence. The first one, which is usually a presumed factor, is if you've got voting rights through shareholding, which range from 21% to 49%, then we'll presume you to actually have significant influence over that investee. So from 21% to 49% shareholding, that gives you significant influence through those voting rights. But there are also other factors which are noted when you go to paragraph 28. So paragraph 28 notes other factors that you can also consider, which are, for example, when you've got the ability to appoint a director to sit as part of the board. That director is going to represent your concerns. So at that point, we then say you've got representation which can give you significant influence. Also, we look at if you're trading with that company and you've got a major part you've got a material transaction that you enter with that particular investee, then also that can be resemblance of some form of influence. Then sometimes if we also consider if you've got technical advice that you provide to the investee. So if you're providing any essential technical information to the investee, which assists in the way that they operate, then we can also say we've got some degree of influence. So when you go to paragraph 28, go through all the factors there. It will give you all the factors that you need to consider for you to say you've got significant influence. So you've got paragraph 28, IAS 28 paragraph 6. So you see 6A, 6B, 6C, those are all the factors that you need to consider. Now, once you are happy that you've got significant influence, then you jump into equity accounting. Now, before we jump into the actual accounting part, let's also talk about sometimes you will have shareholding which is not within the presumed range. So we said the presumed range is between 21% and 49%. Sometimes you can have shareholding which is to the extent of, let's say, 10%, for example. Now, for that 10% shareholding that you have, normally that is not supposed to give you any significant influence. But we also consider voting rights. So when you've got voting rights that you have potential voting rights, when you've got potential voting rights, those potential voting rights should also be considered. So you need to go back to the class which you did with HOP, which was for IFRS 10. It talks about potential voting rights. But essentially, your potential voting rights are considered if they are substantive in nature, which means are they currently exercisable. So let's say you've got 10% shareholding and you've got 15% potential shareholding or potential voting rights. And those potential voting rights are currently exercisable, which means you can convert them into ordinary shares at any point in time. So for those ones, you also account for them, which means you take your 10% existing, you take your 15% potential, which takes you to 25%, and that 25% gives you significant influence. So at that point, we then say you still need to equity account by combining your existing and your potential. The two of them give you significant influence. Therefore, you're supposed to equity account for that investment in an associate. So let's do a small example that I have over here, just to illustrate potential voting rights. So let's say, ladies and gentlemen, we've got an entity which is called H Limited, and H Limited has got a 10% shareholding in A Limited. Now, A Limited issued rights that are currently exercisable as of today or during the year. And H Limited, if they exercise, they would have 30% shareholding in total upon exercising of their rights. And unfortunately, they do not intend to actually exercise that right because they do not have the financial support or financial capability of doing so. So do you think H Limited has got significant influence over A Limited? So you go back again, you go back to what we did before. Start with the existing. So they've got 10% shareholding currently. 10% will not give them any significant influence. But they have got a rights issue which was done, which if they exercise will give them the ability to get to 30% shareholding. And the moment you've got 30% shareholding, then it's presumed that you can actually have significant influence. So by the virtue of them having potential voting rights, which can take them to 30%, then they can have significant influence. But for us to consider those rights issued, they need to be substantive. So we need to look at, are they currently exercisable? And when we look at our scenario, they actually say that these are currently exercisable. So to this effect, that means we need to equity account our investment in A Limited as an associate. Now, though they talked about not having an intention to do so and not having the financial support to do so, this does not matter. You do not consider these in your assessment. So let's jump now to the accounting part. So how do you account for an investment in an associate? Now, there are two types of accounting that you need to consider. The first accounting is when you make an investment, there's accounting for that investment in your own separate books. So you need to consider, how do you account in your own separate books first? So accounting for investment in associates, investment in joint ventures, investment in subsidiaries is done in IAS 27. So IAS 27 paragraph 10 gives you the accounting models that you can use for investment in associates, or investment in joint ventures, or investment in subsidiaries in the separate books, which basically they say you can opt to account for investment at costs, or you can opt to account your investment using IFRS 9, which is at fair value through profit and loss, or at fair value through other comprehensive income. That's your second option. And you've got a third option, which is you can actually use equity accounting in your accounting for your investment in the separate books. However, for the purposes of CTA, we do not examine paragraph IAS 27 paragraph 10b and c, which means for examination purposes, we'll only examine you to the element of costs only. So which means for examination purposes, all investments in associates, investment in subsidiaries, investments in joint ventures will be accounted for in the separate books only at costs. But now we need to jump from separate books and get into the group financial statements. So when we go into the group financial statements, we jump from IAS 27 and we go to IAS 28. So the accounting for investment in joint ventures and investment in associates at group level is covered by IAS 28. And IAS 28 says you need to do what they deem to call equity accounting. Now, equity accounting is quite simple. For equity accounting, what they simply mean is you account for investment at costs, which means you take the costs which you had in IAS 27, that becomes your starting point when you get to group level. So you take costs. Once you've got your costs, you need to add your share of profits to that cost. So each year that your investee is operating, if they make profits of 10,000 and you have invested 30%, then you take 30% of that 10,000 profits, which means 3,000, you add that 3,000 to your investment. Then sometimes the investee will choose to give dividends or to issue dividends out. And when dividends are issued out, that actually reduces the value of your investment. So you need to reduce the carrying amount of your investment by any distributions which are made in the form of dividends. Then there are also gains which go through other comprehensive income. When you do that, you also take your share of everything that goes through other comprehensive income. That gives you the total balance of your investment in associate. Then your investment in associate is accounted for in the balance flow statement of financial position under the non-current asset section. So that's your presentation. So in a nutshell, if I can illustrate, I still remember when I did my CTA, to understand equity accounting, I used to take my investment in associates just like a bank account. So if you consider your bank account, and say, if this was to become a bank account, which is representing my investment in an associate at the moment. It starts with the money that you put into the bank, which means day one, you start at costs. So you put money into the bank. Now, what happens when you put money in the bank? If you keep it in the bank like that, ideally it's supposed to generate some interest. And in investment and in associates, your interest is resembled by the share of profit. So the money that is being made by your investment increases the value of your investment. So which means we add it with the share of profits there. So this is your starting point, the cost, the share of profits increases your value. Now, when you go and withdraw money in the bank, what happens to your bank balance? Ideally, your bank balance is supposed to reduce by any money that you take out of the bank. So each time you are given a dividend, you are taking back money that you invested. So that dividend will then reduce the value of your associate, which means to get the carrying amount of your investment in associate, you start with what you put as an investment, the share of profits which is generated, less the dividends which were given to you. That gives you the carrying amount. So that's also another way of trying to remember how to account, to equity account for your investment in associate. Okay. So let's jump and talk about how to transfer all of these to the different statements which you have, because at the end of the day, you're supposed to be able to transfer and prepare financial statements. So when you've got an investment in associate, obviously, number one, it's going to affect your statement of profit and loss. It's going to affect your statement of financial position. So in the P&L, obviously, you're going to take your share of profits there. Then but when you take your share of profits, remember, you're taking net of tax, because you don't take the profit before tax, you take the profit after tax. So this one comes net of tax. Then you also take any share of what went through the OCI. So if there's any revaluation gain which was done, you also take a share of what went through the OCI, and point to note again net of taxation. Then we talked about the statement of financial position. It goes under the investment value, goes under non-current assets. So that's where you put your investment in associate or investment in joint venture carrying amount balance. Then also we've got under the statement of changes in equity. Remember, each time we've got something which is going through the P&L, it closes to the retained earnings. So expect that under the statement of changes in equity, we've got retained earnings which is affected by the share of profits which we've taken. But we've also agreed that you also take share of OCI here. The moment you've got anything which is going in the OCI, it creates a reserve. So which means we also expect you to have the share of the OCI reflected under the statement of change in equity in a certain reserve which would have been created. So that is the expectation, ladies and gentlemen, which we have. So at the end of the day, when we look at the calculation of your balance, you start with your costs. Then when you've got your costs on day one, it's also important to note that sometimes when you invest, you don't invest at exactly the fair value of the identifiable net assets in the investee. Sometimes you pay more because there's an element of goodwill which is sitting in there, which the investee is charging you. But for the purposes of equity accounting, we don't account for the goodwill separately. So we only account for the investment at cost, just like that. But sometimes when you are investing, but the amount that you've paid with your consideration for that investment is below the carrying amount, the fair value of the identifiable net assets, which means ideally you've underpaid, you've been undercharged. The amount which you are supposed to pay is less than the fair value of what you're getting. So in that case, that means you've got a bargain in this transaction. So when you do have a bargain, that bargain is accounted for and it goes to the profit and loss account. And so that will be the credit side, and it adds to your investment balance. So that means each time you also need to test for any bargain. This one is covered by paragraph 32 of IAS 28. Then we also talked about the increases which are there, which are the increase by the share of profits, the increase by share of OCI, and then we also talked about if there's a dividend, it actually reduces the value of your investment. Okay, please check note that you also need to test for impairment for your investment since it's an asset. So it also gets tested for impairment under IAS 36. If there is an impairment, you need to reduce the carrying amount to its recoverable amount. That's how you get to the carrying amount of your investment in an associate or investment in a joint venture. Okay. So in a nutshell, ladies and gentlemen, that is how you account for investment in an associate. Okay. So for now, I'm going to stop here for now. There's going to be part 2, which we're going to start with just after this video. So for part 2, we are now getting into, let's talk about the intra-group transactions which can happen at investment of in associate level. How do we account for those intra-group transactions? Thank you very much.